Hello and welcome, traders. I am Rachel Dashiell, Senior Manager of Trading Services and your host for this long options webcast. Now, we make the assumption that you are already familiar with the basic concepts of options. If you are not, you are more than welcome to stay around, but you may want to check out the Getting Started with Options webcast series first. Now, I am joined in the chat today by my good friend Kevin Horner. Please chat in your questions, comments, requests during the session today. We'll be sure to keep an eye out for those. And please follow us both on X. I am Rachel-CS. He is Kevin Horner CS. And please like this video, smash that like button, whatever you need to do to get other traders to be able to find this information online as well. And please subscribe to us on Trader Talks Schwab Coaching. Now, today I do have a few bullish setups for you, a couple of support bounces, maybe looking at stocks that are in volatility squeezes and breaking to the upside. So that's what we're going to focus on today, is scanning for some of those and placing some example trades here for you today. But before we get started, let's hop into some important disclosures here. So options carry a high level of risk and are not suitable for all investors. The information we're going to cover here is for general informational and educational purposes only and should not be considered any type of recommendation or advice. And we are going to cover a few examples using the paper money software application. Keep in mind that there are some differences between paper and live. Now for our agenda, we're going to start the same way we normally do with our market overview. We're going to review our past trades. Then we're going to discuss the concept of long options and those concepts of price, time, and volatility and how they're going to impact our option price. And we're going to end it with placing a few example trades on the paper money platform. Now, one last thing before we dive into our Thinkorswim platform to take a look at the market, let's first just kind of cover something that we do have available for new investors here on Schwab Coaching. So I and Alex Coffey actually teach this brand new class on Thursdays at 4 p.m. Eastern Time, and it can be found on our Trader Talk Schwab Coaching channel. You can actually find the entire playlist under playlists here. But we are teaching a new to investing class. So this is for maybe young investors that may be just getting started, maybe working their first job, saving a little bit on the side, and maybe looking to kickstart their investing process. Or this can be a new investor that came in later in their life and are looking to just get started. So if you do have children, if you have nieces and nephews, grandkids, or friends or family members that may be new to investing, you can check out this new series that we have, and it's going to be 20-minute episodes every Thursday at 4 p.m. Eastern Time, archived to our channel here. So I wanted to mention this brand new class that we have. Definitely one to share with any of your friends, family who may be new to investing. Well, now since we've covered that, let's dive into our market overview. So the S&P 500 is seeing a little bit of a pullback today. I do want to look at a shorter term perspective of this one, because something that we're actually going to focus on as we talk through some of these trends that we're going to identify today, we're going to look at them on multiple time frames and try to find some alignment there for our strategies. And so what we're kind of seeing here with the S&P 500, this is a 20-day hourly chart that I just zoomed down to. And what we essentially saw for the last week or so, the S&P 500 was trading in this very, very tight range between 7150 and 7050 here. Now, we did have that breakout on Friday and on Monday to new all-time highs, but we can see how compressed those candlesticks were. That means volatility and price was getting compressed and compressed. We did see a gap down through that old resistance, new support, now new resistance again, which is going to be our resistance to climb over. So our new resistance, it was resistance, became support, now is resistance again. Just the classic polarity example here. So that entire gap ledge right around 71.50 is going to act as near-term resistance. We're going to have old support around 70.50 acting as new support here. Something else I wanted to mention as well, there is an indicator here, the average directional index. This can kind of tell us a little bit more information when we look at the peaks and the troughs of these. Now, a lot of you guys may know, as a trader, we know the ADX tells us the strength of that trend. So anytime that the ADX is below 20, it tells us this is a non-trending environment. It's pretty trendless at this point, which is kind of what we've seen over the last week or so. But the troughs are pretty important because they tell us that the market is about to kickstart a trend in a trend direction. We don't know what direction that trend may reside in. And so far, right now, it looked like the price peaked at the same time the ADX found a trough there. So that could be telling us that price is about to trend down for a little bit, maybe entering more of a corrective phase here. So let's take a look at some of our past trades. Okay, so one of our trades that we had on was Palantir. And I'm going to pull this up on the chart here. And we were essentially trading a support bounce off of these lows with a long call option. So I'm going to go to our monitor tab, look at account statement, and we can see all the trades that we've recently done. Now, keep in mind that I did not teach this class last week. I was coming back from the trading workshop in Boston, so we did not necessarily get to place these trades together. I went ahead and placed this trade myself for the class to just kind of talk about this one. And this list you'll see here will also show some of the trades from the price patterns class. So we're going to ignore those. But the one in particular that I want us to look at is this Palantir. We have the 18th of June, 2026, 130 strike call. You can see we had 4 contracts of those, okay? So we took profit on half of the position and we raised our stop. So we took profit at half of the position with an exit price at 27.05. We raised up our stop to 23.90, and that's where we got stopped out with the other half of the position. So we did end up taking profit there. We also closed out the Coinbase Iron Condor. I think we did that together maybe, but we did that right before expiration there to make sure we took our profits and mitigated our risk prior to expiration there last week. So, a couple other trades that we're actually still in. We're still in the Starbucks trade, which we are actually almost at our 20% loss on that position, which I think is where we placed our stop to the downside, somewhere near there. On Starbucks, we were trading essentially a bull flag setup. So, let me actually pull that up on the chart so you guys can see what we were trading in the past. We had this bull flag set up here, and then price seemed to create almost like this double top pattern. I'm going to actually kind of show you what I'm seeing here. We're going to take off some of these drawings. Okay, take off some of these drawings. You can see what price is looking like it's doing right now. It's creating a little bit of a double top. Now, we can't call it an official double top because price hasn't broken this neckline area of support. We do have our stop coming into place right below here. But the reason why we are going to close out this trade today is because we do have earnings after the market today. And while we may see an earnings reaction result in a move higher that could benefit our call option, we still want to tread lightly because of the level of implied volatility. We know that leading up to an earnings event or a possible important crucial event for a stock could lead us to experience higher levels of volatility. And then once that event is done, the information is out there. The market has had time to digest it. We know that the implied volatility tends to crash. We call it vol crush here, and it has the opposite effect of our options. It deflates the value of our long options, which is something that we don't want to happen here. So what we're going to do essentially is we're going to cancel this OCO group, and we are going to place an order to just close out this position now. We're just going to say, hey, cut our losses at where we're at. And we're going to get out of this trade prior to earnings. So we're going to hit confirm and send here and hit send in this case. Okay. And I see a request in the chat. Increase Rachel's font size. Yes, I actually, I know I asked a couple folks today if this was going to be large enough. I'm actually glad you put that in the chat. Let me make this a little bit bigger. The reason why I kicked it down to medium was because I wanted to go through the scan tab today and the conditional order entry window. And sometimes too large of a font can kind of block some things. So I may have to move that back, but I'll move it up just for now so that you guys can see that. So thanks for the feedback there. Want to make sure you guys are not only hearing me through the webcast, but can actually see what I'm trying to teach. So, perfect. So let's look at another one. We have our leap option and Ross, and we've just kind of had that one contract kind of hanging there. We've seen a little bit of a pullback from the highs, but it has been consolidating over a certain level. Now, they do have earnings coming up about 3 weeks, 4 weeks from now. And what I thought we could do in this class is something a little different than we typically do when it comes to this trade. So we know a lot of the times with our leap options, since they are more expensive, we are buying higher levels of implied volatility into the future. We are buying more time. So obviously, when we put on a position like this, kind of putting on the hat of a long-term investor, we are also kind of coupled with the fact that, hey, this is going to be a more expensive position that we're going to put on. There are times throughout the year that we're going to be holding this long option that may give us some opportunity to possibly sell a nearer term option against this longer dated option to kind of finance that long or that leap option there. And some of the times that this opportunity comes up is around heightened levels of implied volatility, maybe the stock kind of pulling back a little bit from highs. So let's take a look at that actually in Ross stores. We're actually going to place a diagonal on this. So let's take a look at Ross. Okay. So right now we're still a little far from earnings. I mentioned that before. So we do have kind of this higher heightened level of implied volatility here. If we want to actually check the IV percentile, which shows us the current ranking of this level of implied volatility, we can check that right here and we can see that it is in an IV percentile of about 63% here. Okay. So this is kind of on the higher end of a level of implied volatility, and this could be telling us that, hey, maybe we have an opportunity here to pick up a little near-term premium, okay? So maybe just over the next couple weeks, because we maybe want to make sure that we have a near-term option expiration that expires before May 20th, because that is when our earnings release is. We don't want to be trading around that time. So we're going to look at something very short. So maybe just a couple weeks until expiration to take advantage of some of these heightened levels of implied volatility. We're going to sell a call option against it to say that we are short-term neutral here. Because as you can see, the price of Ross has been actually trading in this little range over the last week or so, or last week and a half or so, okay? So you have this little range here, and we're gonna look at this on, we can look at this on a shorter term here, and I'll kind of show you guys what this looks like. Okay, We're going to hide some of these things. You can see how tight this range is. So this is kind of from, let's say 230 down to 224. Okay, so that's about a $6 range that this stock is trading in. And we typically know as traders, we know that the market tends to like symmetry in price, likes to like symmetry in time. So if this is a $6 range that price has been trading in over the last week and a half or so, we can kind of assume that, hey, when it comes time for that stock to eventually break out of this range, whenever it does happen, we could be looking at roughly a $6 move. So that could put us down to, let's say, 218, maybe down here at this level where we see this prior gap and this ledge around here. So that could put us right around 218 or so. Or that could put us at this level to the upside right around 236 or so. Okay, so we're going to mark that as well. So a couple different ways that we could look at it. Okay, so those are kind of our levels there. So maybe what we want to do as a short-term trader here, we're going to say, hey, within the next couple weeks, we want to look to sell something that is maybe a little bit above that 230 level. And just because price has been in this tight range, we kind of expect it to stay in this range. And if it does break out, we could see that, hey, it may take actually a week and a half or more, depending on when it breaks out, to get to one of these levels to the upside and downside. And of course, patterns are not guarantees, but let's kind of keep that in mind. So let's look at the trade tab and let's look at something with roughly 2.5 weeks till expiration. So that gives us the 15th of May here with 17 days left until expiration. And let's take a look at some of the levels we were just talking about. Okay, so one of the levels I mentioned to the upside was that measured move that could take us possibly to around 236 or so. And so we see 235, kind of roughly around that level. We also see 232.5 as well. It gives us a little bit of a tighter spread there. So we could look at that level there and just say, hey, that's slightly above our level of resistance in this very tight range that we're trading at right now. So that may be a level that we tend to look at there is maybe this 232.50. You'll also notice that it has a delta of roughly 32 cents here, telling us that, hey, if this stock moves up $1, our option will roughly move up 32 cents. And it's telling us that possibly this is giving us about a 32% probability that this option could be expiring in the money. So let's take a look at that one, the 230 or the 232.50 strike call, and we look to sell this option here. Okay, so we're going to ask for the midpoint here. We're going to hit confirm and send this to our long options class here. And Kevin with another pro tip, just kind of like I mentioned, you know, these patterns are never guarantees, measured moves are never guarantees, but again, they can be used as a as kind of a tool in your tool set as a trader for kind of some trading guidelines, levels to manage risk at, levels to implement strategies at. So that's kind of what we're doing with that last one. Now let's kind of pivot to the meat of the discussion today when I told you we would be looking for stocks that are in a little bit of a volatility squeeze here. So looking at very low volatility stocks that possibly have support bounces or breakouts today. So let's quickly build a scan for that. I'm going to move to the scan tab here. And we're just going to start with a couple basic filters. We're going to start by scanning in all listed stocks here. And we are also going to look for stocks that are greater than $10, and we're going to look for stocks that have a 50-period moving average or a 50-day moving average, or 50-day average, I should say, of volume greater than 2 million. The reason why I chose 2 million because the higher the liquidity of the stock, likely the more liquid the options as well. We're going to add another filter because as we already talked about, we kind of want to avoid trading around earnings. We want to look at stocks that have lower levels of volatility. And we know that if there is earnings coming up, we are likely going to see a little bit of heightened levels of volatility. So we're going to use this study filter on the right-hand side. Keep in mind, this study filter is only available for you if you are in live trading. So if you are in paper money and you see that when you click on study, that message shows up that study filters aren't available, it is because you need to switch over to live trading. So just making that little disclaimer before we dive in here. So we're going to select study. And we're going to click the drop down, go to corporate actions and select earnings. And let's say we don't want earnings anytime in the next month. So we know that there's roughly about 20 trading days in a month or so. So we're going to say does not have an earnings announcement anytime in the next 20 bars. Okay, so we're going to hit scan from there, see where it leads us. Okay, so we have about 246 stocks left. Well, what's the one thing we're forgetting right now when we're saying that we want to look for stocks in volatility squeeze or stocks with low volatility? We need to put in that filter for low volatility. So we're going to add another filter for study, and we're going to come down here to volatility, and we're going to look at the implied volatility percentile. Now, the reason why we are looking for low volatility is because this is a long options class. Now, levels of low volatility tend to favor a market environment that is favorable for option buying. And that is because when there are lower levels of volatility, the premiums are a lot cheaper, and then vice versa. When you see heightened levels of implied volatility, the premiums are going to be more expensive, and that's going to favor an environment for more likely than not option selling. So that's kind of why in the last example, we placed a diagonal trade there where we sold a near term option because of the heightened level of volatility. And it also says, hey, we have that obligation to sell our stock at a price. We're looking to collect a little bit of income there. But in this case, we're looking for stocks that have lower levels of implied volatility. So we're going to look in between, I guess, 1 and 30. We're going to look at this percentile from a kind of in thirds. We're going to say we're going to look for a stock that is in about the lower third of where its implied volatility has been in the last year. So that's what that IV percentile is. It's essentially just taking all the data of a particular stock over the last year as far as implied volatility goes, and it's ranking where the current level of implied volatility is. So that's going to give us some results here, and let's take a look at what it gives us. Okay, so we have a few different examples here. So if you guys can take a look at this, we have a few different things that we could kind of choose from. Now, a couple of these are kind of piquing my interest here. Let's take a look at UnitedHealth here on this one. So we're going to take a look at the chart of UnitedHealth today, and we're going to use that as an example. Okay. So we can see they just recently had earnings, had a gap up from earnings. Big move today. We can also see that the implied volatility, if you look down below here, is at some of the lowest levels that we have seen all year. So this can definitely favor an environment for option buying. Now, of course, when we are buying options, we are getting very directional here. So we want to make sure that there is a clear-cut, definitive trend in place for a stock before getting directional in this case, or at least we need to have enough conviction to lean into our bias here to place a directional trade in this sense. So you can't just use lower levels of volatility with long options. You also have to pair that with your conviction with the trend and the time frame that you're looking to trade. So I guess kind of side note, we did see a survey that got popped there in the chat. I would definitely ask you guys to please take about 10 seconds to fill out that survey. I read every single one of your guys' comments. I love all the feedback that you guys have given. It helps me build that feedback into these webcasts as well. So please continue to share that with me here. And I see another comment in the chat. Chris mentioned a cup and handle breakout. So that's what I'm possibly seeing as well here. So look at what we're kind of looking at here with United Health. I'm going to zoom in here so you guys can see it a little bit closer. But we had this old resistance right here around 357. And you can see price knocked its head a couple times on the door there, kind of forming this almost candle or this almost handle. You see the cup forming here, the handle forming here, and you could see that breakout today with a strong move above resistance. Now, something about price breakouts. Typically, when you see lower levels of implied volatility like this and you see price breaking out to the upside, typically you see an increase in volatility accompanying a breakout. So increases in volatility don't always have to be bearish, they can be bullish as well. And this is kind of what you're seeing. So one could kind of expect, since volatility is mean reverting, you're seeing volatility at some of the lowest levels this year, you could see that reversion in implied volatility to the upside. And then you're also seeing this cup and handle break. Now, something else that's kind of catching my eye here is this could also be a possible pennant pattern too. If you take a look here and we connect some of these candles here, or I guess we can actually go here, maybe a flag, I should say, we're having a possible bull flag pattern. Now, bull flag is a bullish continuation pattern. This is a strong move, a strong bullish move, kind of a sharp move, typically leading up to in a little bit of a consolidation, a short-term consolidation that doesn't pull back more than half of this initial move, which we're kind of seeing here. And then we typically have that break to the upside, which is what we're seeing today. So this is looking indeed like that possible bull flag. And if I duplicate this flagpole, this can actually be used as a measured move to the upside. Again, no guarantees on this, but a measured move to the upside could take us another $32 higher, which actually could have us run into a little bit of resistance right around this 382 level here, which is where we're seeing. So that could give us another about $14 to run in this case. So let's take that approach and place a long call trade on United Health here, and let's talk about a possible move from this one. So this has been in an uptrend, it looks like, since the lows. So it's been roughly a few weeks of time. This bull flag took about a week to form in this case. So this could tell us that, hey, we could reach 388, which is that measured move. We could reach that within this week or so, or the next week or so, I should say. So if we're going to take a trade here, we're going to keep all that in mind. We're going to go to the trade tab here on United Health. And we know that with our time decay, we know that that time decay kicks into high gear around that 30-day mark. And so we want to make sure, even if we are holding this position for about a week or two, we want to make sure that still we don't see a quick shift in time decay. So we're going to look at the 18th of June 2026 here with 51 days left until expiration. And I actually want to do one more little look here and scroll down. You can see the IV percentile is at 3% here. And we're going to scroll back up and we're going to select a strike price here. So we've kind of always talked about how we want to look a little bit in the money to have an intrinsic value. We want to look at possibly a little bit of a higher delta to catch more of a move on that option should the price of the stock move in our direction. So what we're going to look at here is a 360 strike call with a 61 delta. You can see here the theta decay is going to be about 16 cents a day. It's only going to get greater and greater the closer we get to expiration. Your vega, your volatility sensitivity is going to tell us, hey, with a 1% increase in implied volatility, this option is going to move up about theoretically 53 cents or so. And this is a pretty tight spread between the bid and the ask, very liquid option here. So we're going to take this trade, we're going to right click on this option, and we are going to buy custom, and we are going to go with OCO bracket here. And we're going to crank this up to about 4 contracts here on this one because we do have about $10,000 that we could place into a trade. So we are essentially risking with this trade, saying that, hey, we think that the market is going to continue to move up in the desired trend direction. We are essentially risking that entire premium. So that's 2160. So that's $2,100 roughly, close to $2,200 times 4. So that's roughly going to be about $8,640 that we would be putting to risk in this trade. So that is our max loss on the trade in that case. Okay. Now, we do want to make sure that we do keep our trade risk to a certain amount, or and we like to keep that to roughly about 0.5% to 1% of the account. So what we're going to do is we're going to put a 20% stop on the downside. We've used that number quite a bit over time. So we're going to take our midpoint of 2130, and we're just going to multiply that by 0.8. And that gives us, we're going to use, yeah, we're going to use a 25% stop in this case. So we're not going to make it too tight. We're going to do a 25% stop. So we're going to take 2130 times, let's do 0.75. Okay. And that puts us right at 1597. Okay. So that's going to be our stop to the downside. Keep in mind that that stop is going to activate off of the asking price, and it's going to become a market order. So keep in mind there's a couple risks with that. If the stock gaps down overnight and opens at a completely different price, the price of your option may not necessarily get triggered at or near your stop price. So keep that in mind. We're looking for immediate execution in this case. And then as far as our limit to the upside, let's just say price does move to our measured move to 388. So let's just say it does move another $20 for our measured move within the next week or so. Let's take a look at what the impact that would have on the price of our option. So what I'm going to do is go here to this our kind of column headers here. I'm going to change that to Theo Price Mark, and I'm going to say, hey, if the stock, let's say, goes up $20 within the next week. So that is, what day is today? The 28th. Okay, so that's the 5th. So that's the measured move. That's taking the time that it took to complete that flag pattern and projecting that measured move to the upside. Where could that place the price of our option? And so right now the mark price of our option is roughly $21.25. That could place a Theo price of our option up near 34.10. Now, if we did want to be a little bit more conservative, kind of like what we were looking here, where we said, hey, we may run into a little bit of resistance right around 383. Maybe we look at 383 and say, hey, what does a $15 move look like instead of that full measured move of $20? So let's take a look there. And this will give us our measured move here right on this one. And of course, I lost my OCO bracket. That's happened to me before. Let me just build this one more time. It'll be pretty quick here on this one. I think we said roughly, was that 16? Yeah, that was roughly $16. And then our limit to the upside, this is just a theoretical price, but it can be used as a guideline for um, placing your profit target. If we are a target trader, not necessarily a trend trader, we're saying, hey, in this case, we're a target trader. We're saying we're going to take profits when the price of the stock, if it does get up to this price, we're going to take profits at that price. So we're going to place it at roughly 30.32 to the upside. So that would be about a 50% gain on that option. So keep that in mind. So we're going to hit confirm and send here on this one. And we're going to go to our long options class here and hit send. Okay. So we place that order there. Now, another one that we could look at is going to be Tesla. So that was another one that we could look at from the results on that scan. So Tesla is our other one here. And something that we noticed with Tesla right away is prices right near this level of long-term support. So right near this zone that was tested earlier this year, had maybe a failed breakdown just a few weeks back, and is holding this level right now so far on a very low implied volatility regime. Look at how low implied volatility has been in this stock for quite some time. So very low volatility regime definitely favors the time for buying options in this case, just because of those lower levels of premiums. We just had an earnings announcement. We're hitting some of the lowest levels that we've seen all year, right at the end of this implied volatility range for Tesla. And a couple different things about this technical level that we're looking at. So we can see that yesterday, Tesla printed this bullish engulfing, or I should say possible bullish engulfing candlestick here. Okay, so it completely engulfed the prior 2 days. But today, price is trading right within, kind of right within the range of that previous body. So with a bullish engulfing candle, to get a confirmed move as a trader to say, hey, this is a true bullish engulfing candle. This is a true bullish reversal. A trader would look for a close above the high of that low day. So I just marked it there. This is the low day that came in, touched that level of support, created a possible bullish engulfing. But the confirmation that it is a bullish engulfing comes from the move afterwards to say, hey, it's closing above 380.78 there. So that could be a trader's view to say, hey, we have put in maybe kind of the same level of high here. We're kind of looking like we're looking like the trend is starting to show a little bit of repair, maybe a little bit of change here because we're putting in a little bit of a higher low, but we need to see confirmation off of that low. So we could say, hey, we may want to buy a call, maybe the same as what we did before, a couple months out from expiration, and say only if the price of the stock closes above that prior high, that engulfing candle, only if it closes above, let's say 381, do we want to take a bullish call trade. Now, where could price possibly find resistance if it did close above the high of this low day, if we did see a little bit of confirmation? Well, let's throw on this anchored VWAP. We talked about the anchored VWAP, so we're going to anchor this volume weighted average price to the all-time high. And we can see throughout the second half, or I guess the last 6 months or so, you can see how many times price rallied up to this valid level of resistance and hit its head on that anchored VWAP resistance. So if the price of the stock closes above this level, we could say, hey, let's take a trade maybe 2 months out from expiration for Tesla, to trade the short-term trend here, to trade this maybe 1 month trend that we have been seeing. and target our upside resistance roughly around 407 here. So that's kind of just one idea on how you could put that possible trade together. So we don't have enough time to go through that trade. Maybe we'll go through that one next week. Should we see that trigger or that confirmed bounce there? But that is kind of what that setup is looking like for Tesla as well. Okay. So any questions there? I do see a couple different questions in the chat. So let's see. UnitedHealth is already above its average true range for today. So why are you doing a long call? Well, if we look at the evidence that is stacking up for United Healthcare, we can see that the long-term trend is definitely showing a change of character here. We had that bull flag to the upside, a clearly defined level to kind of manage our risk at. And if we piece that down to the shorter term, actually, I'm going to take these drawings off, clear this drawing set here. We're actually seeing a confirmation with the shorter term chart as well. So when you're a trader, you're going to look typically at multiple time frames, maybe the long term, a couple short term ones, depending on the time frame that you are trading. And when those time frames align, so if we have a break of a resistance and a bullish setup in the long term, and we also are seeing these stair steps higher in the shorter term chart, that gives a trader more conviction to take that trade. Because remember, trading is all about probabilities. And when you have more signals that are working in your favor, specifically that alignment across time frames, a low to rising possible a volatility regime, these are kind of all of the different steps that build conviction in taking a trade like that. So hopefully that helps. And then let's see, Barbara, you had a question about when to use the percentage stop versus the other choices. So it really depends on the trader. It really depends on the trader. So in our example, we've talked about how in this class we have a trade risk of roughly $10,000. So we're going to risk roughly $10,000 in a trade, and we only want to take a specific risk, which is kind of the difference between our entry to our stop. We only want that to be roughly 0.5% of our account to 1% of our account. So that gives us a trade risk room of roughly 1,000 to 200 or $1,000 to $2,000 that we're willing to actually risk on a trade before we're saying, hey, we're wrong on this trade, we want to get out. So that is why I used those the actual dollar values, because I can measure it and I could say, hey, I know where our entry is, since I knew exactly where our entry it was on United Health, and I could measure that on the downside and say, hey, well, we do have room for roughly about a 25% stop loss here, because if you multiply the difference between the entry and the stop, multiply it by the number of contracts, give ourselves a little bit of margin in case the stock gaps down, that's still staying within our risk parameters there. A lot of traders that are using the average true range as a trailing stop may use that on the underlying stock rather than the options itself. So hopefully that answers your question there. And again, I know Kevin put that survey a couple times in the chat. I would love, love, love to hear your guys' feedback. I would really appreciate it there. I know Kevin, he has done a great job helping us out in the chat here. So thank you to all of you for your questions and your feedback. Thank you, Kevin, for helping us out. Don't forget to follow Kevin on X. He is Kevin Horner CS. I'm Rachel-CS. If you liked our video today, just kind of giving you this example scan that we looked at and a possible setup, maybe showing how you could take a long call trade, maybe for a leap option like we did, turn it into more of a diagonal, short-term, income producing type of investment. And if you did like some of this information, you learned something new, please smash that like button, subscribe to us on Trader Talks Schwab Coaching, and I will see you later, traders.